Hi everyone, welcome back to the channel. My name is Jumoke. So as you know, if you've been watching me for quite a while now, this channel isn't a political channel. On here, we talk about financial markets, we talk about investing, personal finance, and the like. However, it is increasingly difficult to talk about markets and economics without talking about politics. The two sort of go hand in hand. So this video will be split into 5 parts. The first part is financial markets reactions so far and what's happening now. The second part is 2 deeper aspects or deeper analysis that mainstream media hasn't really focused on, but I think needs greater attention. The third part is where we could potentially go from here. The fourth part is what I've been doing and I'm still doing in light of what's happened recently with financial markets. And finally, the concluding part of this video will be on this notion of sustained American exceptionalism. So I think it's important to begin by explaining exactly what tariffs are for those who mightn't understand what tariffs are and the broader implication of what they mean both for the government, the economy, and for us as individuals. Now, tariffs have been used since ancient times, with one of the first recorded instances being in ancient Greece, with more modern applications coming into the system through the Tariff Act of 1789 in the US, and this act saw a 5% tariff on most imports. Tariffs have historically played a very crucial part in policies, not just in the US, but across the world. And I remember when I was growing up and I was studying social studies, my understanding then was that tariffs were for 2 reasons. Number one was for revenues for the government in way of taxation, and the second reason being the protection of infant industries. And one could argue that that remains the main purposes of tariffs, even though it seems like it's being used as a political tool. I think we can all broadly agree that those 2 reasons are the reasons that a lot of governments seem to implement tariffs. A tariff is a tax on imported goods. That means it's a taxation on you as a citizen of that country, which means that taking the US as an example, these tariffs are paid by you, the citizen of the United States, and not by China. I think this was misconstrued by a few people thinking that China was paying the tax. No. You and I are paying the tax to the government. And so I thought it was important to clarify what a tariff is and who actually pays the tariff. So as of today, the US's tariff on China is 145%, and the Chinese tariff on the US is 125%. As of this week, the US president has significantly changed his tone and is a lot more soft and has said that the tariffs will be significantly lower when we come to a resolution. And I'm guessing you've been watching the reaction of financial markets to this tariff news. What we saw was a significant pullback in markets. We saw markets dipping. And although we are exiting this dip in market sentiments remain fairly negative, and sentiment is also cautious on the part of consumers as well as businesses. Now, apart from markets being so hungry for good news, which was reflected, of course, in stocks going higher, 2 other things that we need to take into account is something called short covering and also the fact that companies were reporting their first quarter earnings. Short covering is essentially where an investor believes that a stock will fall because of fundamental changes or, for example, the effects of tariffs, and they borrow the stock to sell it in the hopes that in the future, in the near future, when the stock price drops, they can buy it at the lower price and then return it to the owner. And so they've sold at a higher price, they've bought at a lower price, and they've locked in that profit margin. That's what a short covering strategy is. And so as investors start to buy back these shares to cover their short position, prices increase. So apart from the less negative news that we've seen from the administration, short covering as well as earnings reports have probably in combination acted to lift the markets out of the dip. Now, the question is this rally or recovery in financial markets sustainable? The growth in US business activity is the weakest it's been since 2023. And when the markets turned, investors were rushing into cash as well as gold. And these 2 asset classes performed really well, with gold hitting a record high. Now, the issue is that although markets seem to be recovering, they can turn very, very quickly. And so we still need to have our seatbelts fastened because of the uncertainty from one day to the next. Nobody knows the mind of Donald Trump, so you must proceed very cautiously. Now, we saw a rise in markets on the back of statements by the US Treasury Secretary Scott Bessent, essentially extending an olive branch to China, saying that a deal would be necessary eventually. Now, although he did say it could take years to come to a deal with China, he essentially alluded to the fact that this seesaw state and these tariffs are unsustainable. As of now, nothing has fundamentally changed, and so it's really a waiting game. And as all of this has been happening in financial markets, we've seen sort of the gyration and the volatility in markets. On the other hand, we have the IMF that has cut the growth forecast for the US as well as Europe for this year, citing that risk in the US and globally has increased substantially on the back of tariffs. And this sentiment isn't being echoed by the IMF alone. There are economists as well as market enthusiasts who still believe that risk remains high because the macroeconomy continues to look weak. And shifting the conversation to Europe, we are not insulated or immune. Even the UK's very own Rachel Reeves is currently in the US in talks over the tariff situation. She has said the UK is open to talks, but we aren't in any rush to get a deal done. Now, I do not know if she actually believes what she's saying or if that is just a show of power, but do not get me started on just how bad things are in the UK right now. But the bottom line for financial markets is that recession risks are looming, and whether that is a mild or a shallow recession, we are headed for a slowdown across board. There are two aspects of this conversation that I think mainstream media isn't quite focused on. And I think this actually requires deeper analysis and for the information to be out there so we can all understand how this entire situation affects us and we can prepare accordingly. Now, as the US implements these tariffs in the name of protecting domestic industries as well as increasing government revenues in way of taxation, there is an undercurrent forming that I think we need to be aware of and to understand how this affects us as consumers as well as entrepreneurs, businesses, etc. As I mentioned at the start of the video, tariffs increase the price of imports. And many businesses, particularly in the retail and the manufacturing space, tend to depend on these imports to keep their operations going. When we see an increase in the price of inputs, costs rise. And when these costs rise, profit margins start to shrink. But there is a deeper problem than shrinking profit margins, and this is one of liquidity or the access to credit. When businesses are faced with higher costs, their cash flows are strained. And to stay operational, a lot of them understandably will turn to borrowing. But as the demand for these loans rise, the cost of borrowing will probably rise as well. And this in turn creates two problems. Number one, loans become more expensive, which means that not all businesses will qualify for them. And this will most likely result in a bottleneck in financial liquidity. And as the access to liquidity becomes more and more difficult for some of these businesses, they will have to reduce costs, lay off workers, or shut down entirely. And not necessarily because they were unprofitable, but because of cash flow challenges. The second part is as the government, or Doge, continues to reduce costs by reducing the number of federal employees, with less and less people employed by the government, and on the other hand, workers being laid off by these companies, you start to have lower consumer demand, and that's because people have lost their primary source of income. Lower demand, tighter credit conditions for businesses as well as entrepreneurs, and rising costs can create a perfect storm for economic contraction. Essentially a recession. And so this explanation lends to the sentiment that recession risks remain really high. Now, US government debt is high and it's increasing for numerous reasons that I won't get into, but it currently stands at $36 trillion. But what the US produces as an economy, known as its gross domestic product or GDP, currently stands at around $27.7 trillion. And so there is a gap. and an ever-increasing gap between US debt and US GDP. And so how does the government borrow? Well, they don't just rock up into a bank like you and I would asking for a loan. No, they do it via something called government bonds, which is essentially an asset or an instrument which investors buy. So as they buy, they are loaning to the government in return for a specific interest rate. And different bonds have different tenures. So you can have a 1 year, a 3 year, a 5 year, 10 year, 30 year. And in some cases, you could have perpetual bonds, which means they have no maturity and are everlasting, at least until the issuer decides to redeem or recall them. Now, the biggest lender or buyer of US treasuries or government bonds is Japan, and it holds approximately $1.1 trillion of US debt. And so apart from equity or stock markets seeing this volatility, something else happened in the US bond market, and it was starting to get in a little bit of trouble. And that is because Japanese investors were starting to reduce their holdings of US government debt. To be precise, they sold $20 billion worth of their holdings. And this sell-off marks one of the biggest outflows we've seen over a 2-week period since records began in 2005. This is an unwanted major signal to other investors. And we started to see a change in the rhetoric and the tone from the White House and the government after this event. And if you're interested, I will link below an article from the Financial Times that talks more about this bond market sell-off and the implications. This also lends an explanation to why the US dollar has been weakening of recent times. Although since January, we've been seeing a weakness in the US dollar versus other currencies, there was a spike in weakness over the last 2 weeks. And here's how it affects you and why I think mainstream media should pay closer attention to the effects of a weaker dollar, especially for those who have the US dollar as their main or dominant currency. If the US dollar is your main expense currency and this weakness is sustained or perhaps increases, it essentially means that you are paying more dollars than before for each item. This is on the back of retailers having to increase their prices because they themselves are paying more dollars for their inputs. And on the other hand, you have tariffs, which means that they are paying even more in terms of taxation for the things they import. Most retailers will opt to pass on those costs to you, the consumer. And for these businesses, they are being taxed twice. The first tax is through an increase in tariffs on their inputs, and the second tax is through income tax on their outputs. So either way, the taxman, or in the case of the UK, the taxwoman will get you. So where do we go from here? Now, I think for the most part, we can all agree that to whatever extent this tariff war will cause an economic dislocation in China. It, of course, is affecting the US already and will affect the rest of the world, no doubt. And there have been supply disruptions for large retailers, and if nothing is done in good time, this could be a major problem. Companies that need seasonal stock for summer as well as Christmas will be hard hit by the ongoing situation. A lot of orders have been cancelled due to tariffs. China has sent its orders of Boeing planes back to the US. And even if we get a resolution, the surge in demand after such a time will cause bottleneck issues. And so we'll be faced with challenges either way. And it seems likely that the 10% tariff will stay. Trump has been talking about this for many, many years. And so we won't see a complete eradication of tariffs, in my opinion. But we will hopefully see a significant reduction. Another thing to consider, especially for businesses, is whether the effects of tariff will be a one-off event, a one-off hit, or whether it will be ongoing. And the answer, in my opinion, depends on what each company chooses to do with its operations. Are they going to shift from China to a non-tariffed production country, for example? That could be one solution in the short term. Or are they going to in-house, i.e. bring production back into the US, which undoubtedly will be an expensive solution and most likely a longer term one? It's a very hard call to make, and so it would need to be reviewed on a case-by-case basis. So I got a few comments around how one should be invested in such a time. And I got this one comment that said, well, what about tariffs? How do they affect you? And I'm thinking, do I look like a member of Trump's family or his posse? It affects me the same way it's going to affect the average UK citizen. So ask a better question. Anyway, I've been buying the dip. That's what I've been doing. I've been adding to my positions. And this week, I have been focused on Q1 earnings from the companies that I follow, on the impact of all of this. Apart from the noise, I'm focused on the impact on growth and inflation, and ultimately my interest rates. And as I mentioned, there might be a softer touch when it comes to the UK, but we are not immune. The Bank of England governor warned that this will have a significant impact on the UK. But ultimately, for me and for my portfolio, I see these dips as attractive entry points, and that is because I'm not a trader, I'm a long-term investor. Now, one could argue that American exceptionalism is fast fading. And I think the pace at which the US president capitulated the minute the bond markets started singing is a clear sign of this. Empires do not crumble in a day or a week or even a year. It takes decades, sometimes centuries. You only have to look at history. The US's policies so far have been to isolate China from the rest of the world. Now, I'd like to use this analogy to drive my point home. China is the tiger in the jungle that is trying to stand up to the king of the jungle, the lion, the US. And in the past, this tiger may have been unable to take on the lion by itself. Now, here's the thing. The other animals are probably watching the situation and thinking, it's very interesting that the tiger had the grit and the guts to stand up to the lion. But what if it failed because it was alone? What if we join forces and there are several of us against this lion? That is essentially what's happening in the world today with the BRICS plus. The BRICS are Brazil, Russia, India, China, South Africa. These are the countries that make up what we call the BRICS bloc. A side note, I wrote a paper on oil prices and the impact of the BRICS in 2006, but I digress. As of 2004, we now have 4 additional countries as part of the BRICS, which are Egypt, Iran, Ethiopia, as well as UAE. I'm going to leave you with this question, and I am genuinely interested in hearing your thoughts and your opinions. Is the US going to continue being a hegemony? My answer is yes, at least for the time being. But is the rest of the world equally becoming unsettled and extremely tired of it, and the power the US wields? Also yes. And I think this is obvious from the fact that the BRICS as well as other countries are trying to phase out the US dollar being a dominant trade currency, which means these countries and these blocs can start engaging with each other without needing the dollar. And so this is going to be a very interesting space which you and I will watch together. I'll see you in the next one. Thanks for watching. Bye for now.